In the previous video, we saw that income flows continuously between households and firms. This raises an important question. If millions of firms are producing millions of different goods and services every year, how do economists measure the size of an economy? The answer is through national income. In this video, we'll look at two important measures: gross domestic product, or GDP, and gross national income, or GNI. We'll understand what they mean, how they differ, and how to convert between them. Well, national income is the total value of economic activity within an economy over a given period of time, usually 1 year. Remember from circular flow of income model that income equals expenditure equals the value of output. This means economists can measure the economy in three different ways. They can measure the market value of all the outputs produced, or the total expenditure on that output, or the total income earned from producing that output. In theory, all three approaches should give exactly the same figure. The most commonly used measure of national income is gross domestic product, or GDP. It is defined as the total market value of all the final goods and services produced within a country's geographical boundaries during a given period of time. Now, let's break this definition down. Gross means we do not subtract depreciation or the wear and tear of capital. Domestic means production taking place inside the country's national borders, regardless of who owns the business or the factors of production. And product simply refers to the output, goods and services produced. For example, imagine Toyota operates a factory in the UK. Although Toyota is a Japanese company, the cars produced within the UK count towards UK GDP because they're produced within the UK national borders. On the other hand, if a British company owns a factory in France, the output produced there does not count towards UK GDP because production took place outside the UK. So the idea is simple. GDP follows the location of production. Now, let's look at gross national income, or GNI, which is defined as the total income earned by a country's residents and businesses during a given period of time, regardless of where that income is generated. Notice that the focus has changed. GDP asks, where's the production located? And GNI asks, who earned the income? Let's continue with the previous example. If a British company owns a factory in France, the profits will eventually belong to British residents or citizens. Those profits are included in UK GNI even though they were not produced within the UK. Now consider the Toyota factory in Britain. The production contributes to UK GDP because it took place in Britain. However, if part of that profit is sent back to shareholders in Japan, and that income belongs to Japanese residents or citizens rather than British residents and citizens, therefore, it is not part of UK GNI. So remember this simple distinction. GDP follows where the production took place, and GNI follows who receives the income. Since GDP and GNI measure different things, they are usually not exactly the same. But to convert between them, economists use net income from abroad. This is simply the difference between income earned overseas by domestic residents and income earned domestically by foreign residents. The relationship is GNI equals GDP plus net income from abroad. And net income from abroad equals income received from overseas minus income paid overseas. If residents earn more income abroad than foreigners earn domestically, net income from abroad is positive, so GNI is going to be larger than GDP. But if foreigners earn more income domestically than residents earn abroad, net income from abroad is negative then GNI will be lower than GDP.